today, so most of this course is going to focus on companies and what economists call firms and how they behave. And basically, firms are kind of bundles of physical assets, people, and technology that we'll typically treat as sort of coherent, profit-maximizing individuals. And we'll thus, very rarely spend much time looking inside exactly what a firm is. And so I think it's useful to start out by, thinking a little bit about what the heck this thing that's going to be the focus of all of our analysis really is. So today I'm going to try to talk a bit about what firms are as legal entities. What should and do firms maximize? What conflicts arise within companies that limit their ability to maximize profits? How we can govern and finance companies to try to minimize these problems? As well as why firms exist at all, why everything can't just be done by the market, and some theories of that, as well as alternative to firms, and a bit about what we really mean in the end by firms to wrap up. So there are basically 6 legal types of firms that exist in most developed countries, but there is lots of variations on these. One is sole proprietorships, which is basically like a mom and pop store. Most of the stores, say, on 57th Street. Or most McDonald's, for example, are actually franchises that are owned by an individual person who runs that McDonald's, even though they get the right to it from McDonald's. And basically, a sole proprietorship is just like a lemonade stand. I mean, it's basically just you out there doing something on your own. You have no more protections and no more benefits than if you were just an individual doing the thing on your own. So all sole proprietorship means is that you just run the business yourself. A partnership goes one step further, which is it's a group of people who get together and they all share the liabilities and the benefits of the company. So any person in the company can be sued if the company does something wrong individually, and if some creditor wants to get money back from the company because the company didn't pay them back, they can try to get it back from any of the people in the partnership. And partnerships are the most common way of organizing professional groups, such as lawyers, accountants, doctors, and so forth. The next ladder up, sort of in terms of size of companies, are privately held corporations. So I'll talk a little bit more in a minute about what a corporation is, but the key distinction between a privately held corporation and a publicly traded corporation is a privately held one is owned by a small number of people who only infrequently sell or buy parts of the company, and that tends to be a very costly, complicated process, rather than there being these public stock markets out there which trade the ownership of the company. Publicly held corporations are ones that trade on stock markets, but then there's also non-for-profits and cooperatives. So not-for-profits are tax exempt and highly regulated, and they can't give any of the money that they make to people outside of the company. They can't what's called disperse profits. Whereas a cooperative can disperse profits, but only to people who are customers or workers for the company. Finally, and this is increasingly less common, or at least was until about 2008, in developed countries, OECD countries. OECD basically just means developed countries. It's an acronym. Government-run companies have become increasingly less common. But in 2008, a bunch of stuff got nationalized because the economy went to hell. So we may be seeing a reversal of this trend towards less and less government-run companies. Okay, so we're going to focus in this course, or at least what you should have in the back of your mind in this course, is usually thinking that most of the companies we're talking about are corporations. Now, Botow? What are the legal defining traits of a corporation? What makes a corporation different from the other things I was talking about from a legal perspective?
Has an existence separate from the individual.
That's right.
And
That's a big part of it. That's right. Yeah, that's a big part of it. So the key thing that an existence separate from the individuals does is it means, like an individual, a corporation can go bankrupt, right? And that means that if the corporation can't pay its money, the people who've lent it money can't go after the people who own the corporation and try to get money from them. They can only get the money that's inside the corporation. And this is called limited liability. That means, again, that any bad thing that the corporation does, any money that it owes, people can only try to get it from the money that's inside the company and not from the people who own the company. Whereas in partnerships, you can go after all the people who own the company or who are part of the partnership. But the downside, if that's the upside of having a corporation, the downside of it is that you have to pay the corporation income tax, which is a separate income tax beyond the taxes that the owners pay on any money they get back from the company, that the corporation has to pay on the money that it makes. So people often say that corporations are double taxed, whereas other forms of business are only taxed once. Mariana Magala, what do you think? Do you know what the two main ways that corporations finance themselves are? How they raise money to invest?
Through the stockholders or investors they can invest, and the second one through the government.
Well, that's actually not a bad answer, but in these days. But no, that's not traditionally the main other way. The main other way is debt. So they borrow money from the bank, or they float bonds. So when they borrow money from the bank, that means that one bank comes in, gives them money, they promise to repay that money, and if they don't, the bank can come after them and take whatever the company has. When they float bonds, that means that they sell off these bonds to the public, and then the members of the public have the right, if the company doesn't pay them back, to come and take things inside the company. Now the advantage of debt is that you can actually deduct the interest payments that you make from your taxes. And so that makes it much cheaper to finance a company, at least to some extent, using debt than it is using equity, because when you give dividends out to people, you have to pay taxes. The people have to pay taxes on those, and the company can't deduct it. But the debt holders get very afraid that the company is going to take a lot of risks that are going to increase the chance of its bankruptcy, because they don't have any voting rights, so they can't stop the company from doing that. So what they usually do is, if the company takes the loan, they issue what are called restrictive covenants, which says things that the company is and is not allowed to do as long as it still owes money. On the other hand, equity, the issuing of shares, as Mariana was saying, has these tax disadvantages, because you can't deduct the payments that you make. And the way that equity holders sort of control the company is that they get shares which can vote on major decisions the company makes, and can also elect a board of directors, which has the responsibility of looking out for the interests of the shareholders and of choosing the management. There are also some things, government I should have listed on here, but there's also some things different than or between debt and equity. For example, there's something called a preferred share, which is basically some mixture of debt and equity. It's not, you don't get quite as wiped out if the company goes bankrupt as you would if it's equity, but you also don't get all the voting rights that equity has. Okay, so shareholders officially own the company, but the legal controls that they have can be somewhat limited. So if it's a sole proprietorship, right? Then there's no need for any controls, right? Because the individual runs the business themselves. It's just exactly the same as if they were running a sole proprietorship, except that they have limited liability, right? But if there are many people who own the company, either if it's privately owned or if it's publicly owned, there's a series of legal protections which try to ensure that the company serves the interests of its shareholders. So one is the board of directors, which are chosen by a vote of the shareholders and are supposed to defend their interests. A second thing is voting rights. So they have the right to vote on some important issues. Increasingly, they have the right to vote on the pay of the top executives, but they almost always have the right to vote on really important decisions like whether the company is going to merge with another company. A third level of protections are often protections of minority shareholders. These are people who have only small holdings, and there's legal prohibitions against large shareholders trying to exploit the minority shareholders. A fourth thing is that there's legal requirements for the managers to be loyal to and act in the interests of their shareholders. And if they fail to do that, the shareholders can bring a lawsuit against them. And that's something that's become increasingly common in recent years. If people are getting hot, someone might want to open the window. We closed it because there was a lot of noise outside, but I don't know. Maybe people are okay, it's fine. There are also protections of creditors, like the banks and the bondholders, like these restrictive covenants that I was talking about, and the fact that if the company goes bankrupt, they can come and seize anything that the company has left. Okay, so in this course, we're mostly going to assume that firms maximize profits, but a natural question is this what firms should be doing? Or should they be doing something else? For the moment, I want to assume that shareholders want the firm to maximize its profits, and I'll talk a little bit more about whether or not they do in a moment. One reason that you might think shareholders would want the firm to maximize profits is even if they want to do something else, even if they want to serve some social goal or give to charity, a good way to do that is to have the firm maximize its profits, then take the profits they get out of that and give that money to charity. So a natural question is, should firms be maximizing profits? And the advocates of corporate social responsibility say no. Firms should be serving other sorts of goals. They should be trying to protect the environment. They should be trying to alleviate poverty. They should be trying to, improve working conditions or something like this. And Milton Friedman, in the paper that I had you read, argues very strongly against this view. Shen Gong? Okay. Can you tell me why Friedman is opposed to corporate social responsibility?
One of the biggest reasons he says is that the manager isn't a principal, he acts as an agent for the shareholders. So by making the decision to divert funds for these ends of social responsibility, he compares it to essentially placing a tax on the shareholders because he's taking their money and using it for these goals. And he argues that the manager doesn't have the right to do that because he is not he wasn't politically elected, and he doesn't really have expertise outside his area of management, so he shouldn't be doing these kinds of things.
I'm not even sure I want to add anything to that. I think that's exactly what Friedman says. And that's exactly what I just wrote here. So very, very nicely done. Eric?
Just a question about the article. I agree with what Friedman says for the most part, but what about the situation where each individual maximizing their own profit or utility or whatever reduces the overall? For example, the prisoner's dilemma or tragedy of the commons.
Yeah. Well, we'll deal with a lot of those problems here, but I think that Shen's point is a very good way of answering that, which is that the goal of social policy, and that's what we'll think about in most of this course,